Hi, there's been a lot of talk lately about whether this ceasefire around Iran is actually a real pause, or whether it's just the quiet part before something much bigger. So, in this video, we're going to separate the hopeful story from the dangerous one, and by the end, you should have a much clearer picture of what may really be building here. And by the way, today is Sunday, April 19th in New York, so go ahead and comment the day and date you're watching from. And real quick, if you value the way I break this stuff down, support the channel by subscribing and comment John A.G. Best down below. I appreciate that support, because on the surface, the market keeps trying to tell you this is manageable, temporary, contained, something that can be negotiated, softened, and eventually filed away like every other geopolitical scare. But underneath that surface, you've got a very different setup. You've got talks that still haven't produced a framework. You've got a truce that looks fragile, you've got shipping through one of the most sensitive choke points on Earth still not fully back to normal, you've got businesses already dealing with higher input costs, and you've got investors trying to price peace while also pretending they can price war with the same model. Those two things do not fit together. Now, one of the main ideas floating around is that the recent diplomacy may have been less about resolution and more about time. Time to maneuver, time to move assets, time to harden positions, time to figure out whether the next move is a handshake or a hammer. And whether that interpretation turns out to be exactly right or only partly right, the part that matters for us is simple. If one side is using diplomacy as leverage while the other side is using diplomacy as hope, that is not a stable negotiation. That is a countdown wearing a necktie. That's why I don't think the next stretch of this story is a side issue. It is the story, because if this pause breaks, and if the United States comes back with a much larger strike posture, then the whole conversation changes from, can this be contained? To, how far does this spread? And how quickly does the economic damage travel? I don't buy the easy version of this. Not because every catastrophic scenario is guaranteed, it isn't, but because the supply chain, inflation, and commodity backdrops are all more fragile than the average headline makes them sound. Let's start with the military logic. The basic theory behind a much larger attack is simple. Hit hard enough and fast enough, and the other side will decide the cost of resistance is too high. That's the theory. The problem is that history has a nasty habit of humiliating neat theories. States under direct pressure do not always bend. Sometimes they harden. Sometimes fear breaks morale. Sometimes it fuses it. Sometimes outside pressure weakens a government. Sometimes it makes the public rally tighter because now the issue is survival, pride, identity, and memory. That is one reason I think the easy assumption of surrender is too simplistic, especially with a country that sees itself through a civilizational lens, not just through a quarterly market lens. Now, could there be internal debates inside Iran? Sure, every government has rival instincts and different views on risk. But if a leadership structure believes survival itself is on the table, those internal differences can compress very quickly, the room for moderation gets smaller, the room for symbolic retaliation disappears, and the room for escalation opens right up. That's where this gets uncomfortable. Because the first phase of retaliation in a scenario like that probably would not be subtle. It would likely be aimed at imposing pain, not sending a message, not making a statement. Pain. Regional military targets, strategic facilities, pressure points. Psychological shock. And if the fighting continued after that, then you move into the area everybody knows matters, even if they don't always think through why it matters. Energy. Not just crude in the ground. Not just tankers on the water. Energy is the bloodstream for almost everything else. According to the U.S. Energy Information Administration, flows through the Strait of Hormuz account for about 1/5 of global oil consumption and around 1/5 of liquefied natural gas trade, which is why even partial disruption in that waterway matters far beyond the Gulf. And the disruption risk is not theoretical right now. Reuters reported over the last 2 days that the ceasefire remains fragile. No date has been set for the next round of talks. Vessels have reported attacks while trying to transit the strait, and Britain's foreign secretary said passage there has still not returned to normal operations. That matters because when people hear energy shock, they tend to think only about gasoline. That is way too narrow. Energy touches shipping, energy touches fertilizer, energy touches chemicals, energy touches plastics, energy touches mining, energy touches food, energy touches the cost of moving raw materials, processing them, and then moving finished goods all over again. So even if the absolute worst case never happens, you can still get a very ugly inflation wave from fear, rerouting, insurance, delays, and sheer uncertainty. And we are already seeing the early fingerprints of that. The latest U.S. inflation data showed energy prices surged in March, with the Consumer Energy Index up sharply on the month, and gasoline posting its biggest monthly jump in the history of that series. Producer prices also moved higher in March, with energy helping drive the increase. At the same time, Reuters reported that U.S. factory output dipped in March, and that the Federal Reserve's Beige Book described the Iran conflict as a major source of uncertainty, complicating hiring, pricing, and investment decisions. That is how a geopolitical shock starts leaking into the real economy before the full damage is visible. Which brings us to the bigger mistake markets keep making. They think that if equities stay resilient, the danger must be exaggerated. No. Sometimes markets are calm because they are smart. Sometimes markets are calm because they are addicted to the last narrative that worked. And right now, I think there is a lot of that second one. Investors have been trained for years to believe every geopolitical scare gets absorbed, every dip gets bought, every official reassurance becomes the winning trade. So when they hear that talks made progress, or that another meeting may happen, or that the strait may normalize, they reach for the same playbook again. But this setup is different because the inflation channel is already alive. That is the part I don't think gets enough respect. In a normal slowdown scare, weaker demand can cushion some of the damage. Here, the sequence can run the other way. You can get softer growth and firmer prices at the same time. That is a miserable combination. And it is one reason gold and silver remain so interesting here. Now let me say something important. Gold and silver do not move in a straight line just because the world gets dangerous. Sometimes liquidity stress hits everything, sometimes inflation fears delay rate cut hopes and metals wobble before they recover. Sometimes a stronger dollar gives you a nasty shakeout. So no, every war headline does not automatically mean an instant vertical move. But if this conflict deepens, if energy stays expensive, and if confidence in paper money keeps getting chipped away, then the bigger path for precious metals still points higher. That is the larger thesis. Not one missile, not one rumor, not one press conference. The larger thesis. And from recent market updates, gold and silver have already been reacting to that background. Reuters said spot gold ended this past week near $4,900 an ounce, and spot silver pushed into the low 80s, both posting weekly gains. That does not prove some one-way breakout, but it does tell you capital is still searching for places that are harder to print. And if you're successful, share your success story in the comments so others can stay motivated. Now let's talk copper, because this one is more nuanced. A lot of people look at a possible global slowdown and immediately say, well, copper has to get crushed. Maybe later, not necessarily first. The cleaner way to think about copper here is that it can get caught between two wrecking balls. One is supply damage, the other is demand damage. If supply gets hit first through chemical shortages, shipping problems, fuel costs, and processing constraints, copper can stay firmer than people expect even while the macro backdrop gets uglier. Then later, once businesses cut spending, construction cools, financing tightens, and consumers pull back, demand damage can finally take its turn. That is why I am not in the camp that says copper is just a simple recession trade from here. The more realistic path may be a messy one, an initial squeeze, then a correction. Then, if monetary debasement remains the dominant force, another move higher in nominal terms. And that phrase matters. Nominal terms. Because one of the easiest ways to fool yourself in an inflationary cycle is to celebrate a chart while your purchasing power is still shrinking. Recent Reuters reporting gives you a clue as to why copper's supply side matters. One piece said sulfur, a byproduct of Gulf oil and gas production, has effectively been trapped since the Strait disruption began, while another said Congo's copper and cobalt producers have had orders for sulfur-based chemicals canceled or delayed, forcing them to cut usage and consider output reductions. That is not some abstract whiteboard scenario. That is supply stress showing up in the real world. And if those disruptions persist, the metal story becomes much more complicated than growth down, copper down. Same goes for energy equities, by the way. Could they gush cash in a tighter market? Sure. Could some energy names benefit if the squeeze lasts longer than traders think? Absolutely. But this is also the kind of environment where windfall politics, rule changes, surprise taxes, export controls, or plain old volatility can turn a clean-looking thesis into a dirty trade. So I am less interested in fantasy trades here than I am in survival math, protecting purchasing power, reducing fragility, owning things you understand, keeping some dry powder, that kind of thinking. Now, step back for a second. What is this conflict really about? Because I do think this is where the discussion gets much bigger than Iran by itself. One interpretation says this is about alliance credibility, domestic politics, and the regional balance of power. That is fair. Those are real parts of the picture. But another interpretation, and in my view the more important one, is that this is also about global power, energy access, trade routes, dollar influence, pressure on rival blocs. And above all, the effort to slow China without saying that too loudly every time the map catches fire somewhere else. That does not mean every move is part of one perfect master plan. Great powers miscalculate all the time. But it does mean Iran may be seen by some in Washington not as the final objective, but as one link in a broader struggle over who gets to shape the next decade. That broader struggle is why I also think the complacency around Asia is strange. There is still this constant public story that Beijing wakes up every morning wanting to storm Taiwan tomorrow. I am not convinced that is the cleanest read. Pressure? Yes. Military preparation? Of course. Signaling? Absolutely. But there is still a meaningful difference between preserving leverage and choosing immediate war. When dialogue, political channels, and economic incentives still exist, it is sloppy analysis to pretend invasion is the only script on the table. Could Washington try to obstruct a peaceful shift it dislikes? That is possible. Would that surprise me after everything we have seen? Not even a little. But the larger point is that the world is moving toward a harder, messier, more openly contested order. Less trust. More blocks, more sanctions, more choke points, more resource nationalism, more pressure on the middle. So here's my bottom line. I think the market is too casual. I think inflation risk is more persistent than people want to admit. I think gold and silver still have room over time, even if they stay volatile in the short run. I think copper is a timing battle, not a one-word trade. And I think anyone telling you this whole thing is just a passing flare-up may be underestimating how much of the global system is already stretched thin and one bad decision away from repricing fast. That is what I am watching. Not just bombs, not just speeches, not just ceasefires. The chain reaction. Watch energy, watch shipping, watch inflation expectations, watch whether businesses keep passing through higher costs, watch whether markets keep treating every official statement like a safety blanket, because one day that blanket catches fire. And one more thing on the inflation side, because this is where people still get tripped up. They hear higher oil and they think, okay, pump prices go up for a while, and then central bankers clean it up later. That is too neat. Even when energy stress cools, the aftershocks can linger through freight, inventories, insurance, supply contracts, and delayed investment. A short conflict can cast a longer inflation shadow. That is also why the comparison to the 1970s keeps coming back. Not because history repeats line for line, it does not, but because energy stress leaks into everything, and once businesses realize they cannot absorb it all, they start passing it through in waves. Now, does that mean we are guaranteed some apocalyptic spiral? No, and I want to be careful here. There is a skeptical case. The skeptical case says the market is not asleep. It is betting that major powers understand the cost of a true regional energy catastrophe, and therefore will stop short of the absolute edge. That is possible. In fact, that may be exactly why some assets have not blown out even more. But even if that skeptical view is right, you can still have a period where the fear of disruption does almost as much damage as disruption itself. You can still get slower investment, tighter margins, and a stronger bid under hard assets. So when I say gold is going higher over time or silver is going higher over time, I am not saying straight up every week. I am saying the background music is changing. And once the background music changes, portfolio behavior changes with it. And as always, this is for educational purposes only, not personal financial advice. I am giving you my read on the landscape so you can think clearly, ask better questions, and make your own decisions.